bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the August 29th, 2023 podcast. And in case you're wondering, yes, it is my birthday. In today's episode, we're going to talk about two new ways to monetize renewable energy tax credits. Now, I say new ways as these monetization options were created last year through the Inflation Reduction Act. So what are these two monetization options? The first new monetization option is the ability to transfer the renewable energy tax credits as if they were separate property. This transferability option only applies to renewable energy tax credits, not other tax credits. Furthermore, it doesn't even apply to all renewable energy tax credits, but most of them can now be transferred. The second monetization option applies only to certain eligible tax-exempt owners of renewable energy property. The second option allows tax-exempt entities to report certain renewable energy tax credits on their tax returns and in turn have the IRS refund the tax credits. This tax refund option is called the Elective Pay option, as it is an election by the tax-exempt entity. It's also referred to colloquial as the direct pay option. Now, previously, tax-exempt owners could only either syndicate their tax credits, use those tax credits to offset taxes on unrelated business income, or simply leave the tax credits unused. As such, the elective pay method gives certain tax-exempt owners a fourth option, namely to claim a tax refund. Now, transferability and elective pay are intended, the reason why they were enacted is they're intended to increase the value of renewable energy tax credits by increasing the options to monetize them. This in turn should increase renewable energy production in the United States. This topic is particularly timely this week because about 8 weeks ago, the IRS and Treasury released proposed guidance, transferability and elective pay. And Treasury just last week held separate public hearings on the proposed guidance for transferability and the proposed guidance for elective pay. Now, these hearings included testimony from two of my partners who are leaders in the Novogradac Renewable Energy Working Group, namely Nat Ing, who's been a prior guest on the podcast, and my guest today, who's also been a prior guest on the podcast, Alvin Lee. Alvin was the organizing drafter of a comment letter to the IRS on the elective pay guidance. That letter was submitted on behalf of the Novogradac Renewable Energy Working Group. Nat Ing was the lead drafter of a similar comment letter on transferability. Now, if you are interested, and I do think you should be, I invite you to join the Novogradac Renewable Energy Working Group. The working group is striving to build consensus around emerging renewable energy issues like transferability and elective. I will include a link to our membership inquiry form in today's show notes. You can also request to join the Renewable Energy Working Group by emailing us at cpas@novoco.com. And that's a great segue back to today's podcast, because we're going to discuss a lot of the input that we received from our Renewable Energy Working Group members. Alvin and I will talk about where the industry stands on using transferability as well as elective pay, and we'll discuss when renewable energy property owners might consider the various options. We'll also discuss the types of stakeholder questions that do remain. And if you're ready, let's get started. Alvin, welcome back to Tax Credit Tuesday.
Good to be here, Mike.
And welcome back to California from your trip last week to DC to testify.
That's right. Very excited, and we were happy to do it, and honored to be able to speak on behalf of the Renewable Energy Working Group.
Great. So let's start with where we are in transferability of tax credits. As I said in my intro, the concept of transferability was created last year through the Inflation Reduction Act. So it is brand new. And I also noted that the IRS just released proposed guidance in June. Now, I personally have not seen any transactions use transferability yet. And preparing for the podcast, you told me you had not either. And there's a variety of reasons for that. So let me ask you this. When do you expect we'll start seeing transfers of renewable energy tax credits?
Yeah, we can talk about that. I think there are a couple of things that need to happen in addition to more guidance that needs to come out. There also needs to be a process put in place. I'm referring to a pre-registration process that's required to be able to actually make the election to either transfer credits or for elective pay. So yeah, I think until those things are resolved, but that said, that's not stopping a lot of developers and investors from exploring various structures and how they could use this new tool that's available to them. It'll be some time before obviously a marketplace or a market's developed, but looking forward to it and glad to help that process along.
And what are some of the issues that are preventing more tax credit transfers from taking place? You mentioned the pre-registration process. That's one. What are some of the others? And feel free to talk more about the pre-registration process for our listeners.
Yeah. So before you can make either of these elections, you need to pre-register the project. And in time, we'll expect the IRS to be able to have some form of an online portal or a place where you can register. And we can talk some more about those issues later. In terms of transferability, one of the main topics or issues that are negotiated is how to handle the risk of breach capture or the risk of excessive credits. And when I say that, the risk of essentially the IRS coming back to say that you calculate your credit incorrectly and some of that has to be returned. And so obviously a lot of these risks of transferring the tax credit can be managed through indemnities to the buyer of the tax credits or insurance that can help protect the buyer. One of the nuances with transferability though, and the investment tax credit is you actually have various bonuses and adders that increases the percentage of the credit you can claim on a qualified facility. Just to mention some of these bonuses and adders, such as energy communities, domestic content, and low income community ease adder. And so currently how the proposed guidance is written is that you can transfer a portion of these tax credits, but you can't necessarily transfer a particular credit, say the adder you get for domestic content. And so when you transfer a portion of the credit, you're actually transferring all the various adders, a portion of all the various adders and the base credit. So you can see how this can be an issue for managing risk because a buyer may look at the base credit, which is just generated off the installation of of a qualified facility, as potentially less risky than the adder credit that you would get from, let's say, a domestic content adder, which has additional criteria and qualifications you need to get that. And so if you think about all these different adders and base credits as almost like layers of credits, like a cake, you're essentially transferring a vertical slice of the cake versus being able to transfer a horizontal slice where you're transferring a particular credit. And so we think, and this is one of our recommendations, and we've seen a lot of comments from the Treasury hearings addressing this issue specifically, where if you are able to transfer a particular slice of the credit, that would make transactions and managing risk for these transferability structures a lot easier. And in fact, we think it's sort of a win-win because from maybe even an IRS compliance standard or audit standard, that'd be easier for them to track where these credits are going.
Well, thank you for all of that. And as you pointed out, many of these issues relate to how the IRS is interpreting the statute. And I know a lot of your comments are about finding ways to increase the value of credits, which will lead to more renewable energy production. So it's not just looking at this from benefiting investors, it's benefiting the market itself more generally. So the credits themselves will trade at higher values. This is a good opportunity for me to mention to our listeners that Novogradac's 2023 Fall Renewable Energy and Environmental Tax Credits Conference is coming up. It will be held November 2nd, 3rd in Washington, D.C. And we will have a much more in-depth discussion on the use of transferability and elective pay at the conference. Then obviously we'll have more time since the guidance came out and the hearing was held. So we might have more insights on both these topics. I'd also remind our listeners to make sure they register for the conference as soon as possible. We do have early bird registration discounts until September 7th, which is next Thursday after Labor Day. I'd also encourage you to make hotel reservations as soon as possible to make sure there's a room at the hotel for you. So now, Alvin, I wanted to switch to elective pay. We've talked about transferability. And with elective pay, maybe to level set for our listeners, in the past, the solar installations that were sponsored by tax-exempt entities would generally be structured as joint ventures. They were structured as joint ventures or partnerships so that the tax credits themselves could be monetized. Furthermore, in that joint venture partnership structure, the monetization applied not just to the tax credit, but also the tax depreciation could be monetized. So it would be value generated from both the tax credits and the tax depreciation. Now, with this new option of elective pay, tax-exempt sponsors can now choose another route. Elective pay allows eligible tax-exempt sponsors to monetize renewable energy tax credits through this tax refund route instead of syndicating the credits. Now, obviously a benefit, or maybe not so obvious, but the reason why it was created was the simplicity, especially for smaller installations. And I mentioned smaller installations because before the elective pay option existed, if a smaller nonprofit installed rooftop solar, or maybe I should just say a nonprofit installed a small rooftop solar installation, then oftentimes the cost of syndicating those tax credits might outweigh the benefits of receiving the tax credit equity, such that the credits would remain unused. And this is where elective pay will definitely make a difference, because instead of just leaving the tax credits on the table, that nonprofit can now claim a tax refund. But there are drawbacks of the elective pay option, which I know, Alvin, you and I discussed in preparing for the podcast, and it's also been a discussion with the Renewable Energy Tax Credit Working Group. One of the drawbacks of elective pay option is it leaves on the table the cash benefit of monetizing depreciation. And that's a pretty notable benefit, and obviously it scales up with the size of the installation. Another drawback is one related to timing. With elective pay, owners don't receive the tax refund until they file their tax return. And that filing of the tax return could be a year and a half or longer after the property is placed in service. And I mentioned the relationship of placed in service because from a syndication perspective, the investor gets the benefit of the tax credits when the property is placed in service. And as a consequence, the value they place and the ability to monetize it is a function of the place in service date. So that delay does reduce some of the value, the economic value. So with that as background, Alvin, to what extent do you think that tax-exempt owners of larger installations will actually choose elective pay versus continuing to syndicate those credits?
Yeah, no, that's a great question, Mike. I think for tech-exempt entities that already have used syndication, I think will likely continue to do so. I think for all the reasons that you mentioned, the ability to monetize the depreciation would likely outweigh the simplicity of elective pay. And one of the recurring themes or recurring concerns about elective pay is really the timing of receiving the payment. And in the Treasury hearings, we heard that concern a lot. Like you mentioned, elective pay option really is a tax refund. And so you don't get the refund until after you file your tax return. So in many circumstances, that's occurring well after the qualified facility has been construction and financed. And so any predictable payment would definitely be needed from the IRS and Treasury to understand, when those payments will likely come through. Is it 2 months after you file your tax return? Is it 6 months? So all those are causes of concern for tax-exempt entities potentially wanting to use elective pay. And maybe another thing I wanted to bring up as well, many tax-exempt entities may also be looking at transferability. There may be a potential option for them to be able to use a blocker corporation to be able to own the qualifying facility and transfer and sell the tax credits instead of using elective pay. And again, this is beneficial because you can sell the credits prior to filing the tax return and receiving payment for that much earlier than potentially receiving a refund. So again, kind of a recurring theme here. Timing of payment is a large concern for elective pay.
And that's a good point about the transferability because I set up the question as the optionality between syndicating the depreciation and the credits versus, applying for the refund. And that's like an intermediate approach. So I'm glad that you shared that. And I would just add that, given all the issues around the cash grant program for tax credits, kind of back in the day, and some of the surprises that investors and developers of solar installations and other types of property found, it seems like the elective pay route, until there's some experience with it, there'll be a bit of trepidation around that process. But I did want to ask you about the proposed guidance. And I was just curious, what other aspects of the proposed guidance do you think will limit the number of tax-exempt entities that will choose to go down the tax refund route?
Yeah, and one of the recurring comments that came out from the hearings was the ability of partnerships to make an elective pay election on behalf of its partners. So currently, as proposed guidance is written, partnerships, even if all the partners of the partnership are tax-exempt entities and qualify for elective pay, cannot make an elective pay election. And so the reasoning for this is that the eligibility of the potential entity is determined at the entity level that owns the asset, not necessarily at the partner level. However, we know many transactions where energy tax credits are done through partnerships, and partnerships allow for renewable energy developers or sponsors to partner with investors or tax-exempt entities, and they're able to provide their expertise and experience in deploying projects, particularly larger projects, while allowing investors or tax-exempts to be able to help participate. And another benefit of partnerships is that it also helps diversify the risk of ownership slightly. You have the experience of the developers for development, construction, and operation. And so, yeah, we commented in our letter to essentially our recommendation is for a partnership to be able to make an election on behalf of a tax-exempt eligible partner. And we believe this would, align with the intent of the IRA to allow for greater access to the benefits of these tax credits that were previously had less options for tax-exempt entities.
And maybe to build that out a little bit with respect to the partnerships owning not being eligible for the tax refund route, the natural question I think a listener might have is, well, what if those credits then conceptually would get allocated to the tax-exempt entities?
Mhm.
And then can those tax-exempt entities then claim a refund?
No, so currently, in the guidance that cannot be done. So it needs to be the election needs to be made by the entity that owns the asset. And you can see maybe for administrative reasons or tracking reasons that might be beneficial in that case. But nevertheless, the guidance doesn't allow you to do that.
That ends up being, as you note, a pretty severe limitation.
That's right.
So as I noted earlier, as we've discussed so far, this proposed guidance on transferability was released sort of towards the end of June. And then there were all the comment letters that were submitted to the IRS on the proposed guidance in very short order. That's not a particularly long period of time to be pulling all the comments together. And thank you for, leading the way in the elective pay comment letter on behalf of the Novogradac Renewable Energy Working Group. I know that was a lot of effort bringing in the comment letters from all the comments from all the various members of the working group. A very, very good letter. And we will post both letters, both the one that you took the lead on and that Inc. took the lead on, as part of the show notes, because it is good for our listener to be reading the letters to see more, some of the comments, some of the concerns, because obviously that comment letter is all about suggested changes. But maybe you could share with our listeners on the elective pay route what some of the top comments or recommendations from the working group were.
Sure. Thank you, Mike. It was my pleasure to work on the letter, and I'll take none of the credit. I think I got very valuable feedback from all the working group members, and it's really with their help, we were able to put together our comment letter. One major issue that was brought up by our working group members was the issue of financing facilities through tax-exempt bonds. So one thing we noted was that we generally expect entities that would utilize elective pay would also likely utilize tax-exempt bonds. And in the IRA, the investment tax credit is actually reduced by the fraction of the qualified facility that's funded by tax-exempt bond proceeds. However, the proposed guidance that came out didn't offer any details on how costs for a particular project that was funded by tax-exempt bonds would be determined whether or not they were, funded by tax-exempt bonds or other financing sources. For example, this might be a particularly important issue for multifamily affordable housing projects that are funded by various sources. And we noted there is existing guidance to help answer some of these questions that would allow for either direct tracing of how costs were funded or financed. There are other reasonable methods in trying to allocate the use of the bond proceeds, such as, determining based on a first in, first out basis or determining based on some sort of ratable method. So there is, context and historical guidance in some of these things. So our recommendation really was for the Treasury for the purposes of, understanding what portion of the investment tax credit might not be reduced due to this tax-exempt bond issue, that they follow a similar guidance that were previously used for allocating costs for tax-exempt bond proceeds. So yeah, I think that was a major comment, and we were able to speak on that at the Treasury hearing as well. So we think it's a great recommendation. Hopefully they pick it up.
Great. Thank you for that. And I know there were a lot of other comments that you and Netting, obviously you testified at the hearings, but by being at the hearings were lots of comments and such that were being made. And I know one area that's a little bit, I won't say nuanced, but it's one that we've been wondering about until the guidance came out. That has to do with passive activity rules and individuals. And for the benefit of our listeners, as a general rule, an individual can only use a tax credit from a trade or business activity if they materially participate in the activity. And from the standpoint of renewable energy tax credits, if these tax credits were transferred to an individual, the individual that's received the credits won't be participating in the activity with which they've, quote, bought the tax credit. However, there are some step into the shoes rules with the transferability, and there was a hope and even a belief that maybe it was the proper answer, that the individual would step into the shoes with respect to the passive activity rules. And the IRS came out in the guidance and said that individuals do not step into the shoes with respect to the material participation rules, which generally means individuals find these credits, the credits would come through as passive activity credits and must be limited to being all offset tax on taxable income. And I know there were comments at the hearing about that rule, and had the step in the shoes rule should apply to the passive activity rules for individuals. But beyond that, beyond those passive activity rules, if you could maybe share with our listeners some other issues that were coming up that are important for transferability and or elective pay to really gain some steam.
Sure. Yeah, I think there were definitely many recurring themes in terms of comments and concerns. Going back to the registration process, obviously that online portal I was mentioning isn't in place yet. And so there are particular concerns of how much time it would take to apply and get a pre-registration number for a project. Because currently, as the guidance reads, you need to have that registration number in hand before making that election on a timely filed tax return. So again, the question comes back to timing. Is it going to take 30 days or 60 days to get a registration number? One of the recommendations we made was maybe having the ability to file a tax return without the pre-registration number if you've applied, and potentially later maybe amending the tax return once you do receive that number. Along with the application to receive a number, you need to submit sort of various information regarding the project and its details of location. And it takes time for the IRS to review all of that. So there are some concerns over how long that process might take and whether that might delay getting that number and making the election timely. Other concerns brought up on the registration process was whether or not you could potentially group multiple projects together for registration. You can imagine, certain projects are made up of multiple assets. For instance, a wind farm that might consist of 100 wind turbines. And so there are concerns about the administrative burden of registering each and every project. For example, many of our residential energy developers might construct and finance and register, residential energy solar systems that can number in the hundreds or even thousands. And so, I think those are some concerns that are brought up. Obviously, I think it's just an administrative process, and I'm confident the IRS will be able to come up with a process that would be able to accommodate some of these issues.
And to what extent, Alvin, do you think that there will be some transfers that happen that the investors are looking at it and saying, we know the guidance isn't out yet, but we're confident it'll be out in time?
Mhm.
Or do you think that for the most part, investors will be saying until that guidance, until you actually key in register, we're not going to agree to buy?
Yeah, I mean, I think you'll have, let's say, more bold investors versus more conservative investors that would probably want to wait until there's extra clarity in terms of what that process looks like. Obviously, I have never filed a tax return yet to make the election, so that's never
Right.
been done before. And so I think that says a lot in terms of how new this process is going to be. But I'm sure in time going forward, these answers will be or these questions will be answered. And, I'm excited to see how the marketplace and will develop and excited to see potentially new participants coming into the space and expanding the program and adding renewable energy capacity to the system.
That is a good segue to my sort of final question, which is really a prediction question. When you think maybe the mid to long term, not the short term, but the mid to long term, how do you see the renewable energy community adopting transferability as well as elective pay?
Yeah, I think for transferability, I think the market will sort of mature and grow. As in, I think a lot of our sponsors and developers and investors will learn how to, use transferability, and in addition, how to combine it with, how they currently get their projects financed. One thing I notice and things that are happening today is that, many traditional tax equity partnerships, investors are requiring or requesting that in the partnership agreement, you actually have the option to sell the credits if the investor didn't want or need the additional credits. This is particularly important or relevant for projects who may qualify for additional adders, such as energy communities or domestic content. But obviously, we're still waiting on guidance on some of that. So that's still unclear. And so, for transactions that are happening in the near term, that's an option to have in the agreement in case the partnership does end up with additional credits that they didn't anticipate. Yeah, and in terms of elective pay, I think, we'll in the near term, we'll definitely expect final guidance and clarity on a lot of the issues that we brought up. So yeah, looking forward to seeing how the market will develop and looking forward to final guidance from the IRS and Treasury.
Well, thank you for that, Alvin. And, it's kind of a difficult question to ask because part of your response is, well, let's see what the IRS does in terms of the comments.
Right. Exactly. Exactly. One thing at a time, Mike.
Exactly. Depending on how the IRS responds to the various comments will have a huge impact on transferability and elective pay. And that is one of the reasons why I was hopeful that the IRS, would see the way to treat this step in the shoes rule as applying past activity rules, because I thought that could really open up individuals being able to invest in renewable energy tax credits. But unless there's a change of view at the IRS, that ship may have sailed. So thank you, Alvin, for being a guest on the podcast this week. Please do stick around for the off mic section where I get to ask you for some fun off topic recommendations and also for you to share some words of wisdom. And to our listeners, Please note, we will not air a podcast episode next Tuesday. That's the Tuesday after the Labor Day weekend. We'll be back on September 12th with a podcast on state historic tax credits with my partner, Warren Sebra. Now, the podcast is not about the state of historic tax credits, but it's actually about state level historic tax credits. Warren and I will discuss what developers need to know if they're planning to use state tax credits to raise additional investor equity. We'll discuss some of the key differences between state and federal historic tax credits. We'll also discuss what you can do if you're in one of the 12 states that don't have a state level historic tax credit. My column in the September issue of the Novogradac Journal of Tax Credits is about the significance of state incentives. And my conversation with Warren will expand on what I wrote about in the journal. And if you have any questions, by the way, that you think we should cover in that episode, please email me at cpas@novoco.com. So now we turn to our off mic section where I get to ask guests some off topic questions so I can get their recommendations on insights. So my first question, Alvin, and it's timely since you just returned from a trip to DC for the IRS hearings, or I should say the Treasury hearings. And it's a question that I think could be useful for our audience as we get ready for the Novogradac Fall Conference Series. What is your favorite travel tip?
Sure, Mike. I think maybe this isn't so much a tip as it might be obvious to a lot of others. But every time I'm flying across the country, I always have this internal debate on whether or not to take a red-eye flight. As a father of a young family and, with being busy with work, the red eye seems like a great way to save time and hit two birds with one stone and maximize, sort of my schedule without having to interrupt it too much with a flight. But I kind of realized over time, losing out on a good night's sleep is usually not worth it. And so I think my advice is definitely try not to take a red eye unless you really, really have to. And maybe it's kind of a lesson that everyone already knew, but I've kind of learned over time and personally decided that's probably not worth it anymore.
No, I always wonder on that question, how much of it's age related?
That's right. That's right.
I'm not getting older, but it seems like a red eye wasn't as painful when I was younger. I definitely try to avoid the red eyes. So my second question has to do with productivity tips. And here, I always enjoy hearing productivity tips, but I was wondering if there's a particular productivity tip that you have related to someone working remotely, or at least having a hybrid working schedule, sometimes working from home or remotely, and sometimes being in the office.
Yeah, no, I think my tip here is also fairly common sense is just having a great at-home setup in terms of technologies.
Yes.
I was very surprised to find out during the initial work from home setups that some of my colleagues were just working off their laptops. And yeah, no, having a good setup, I think one thing that really made a difference for me was having a dedicated webcam, I think makes a big difference. But in addition to that, having a great mechanical keyboard, a great big screen, and a good chair makes a world of a difference. And, usually sometimes I wake up in the morning and I decide to just stay because I've had such a great setup at home that I'm so comfortable in. So yeah, that's my maybe obvious tip.
And do you end up at home having one particularly large screen or multiple screens?
I am of the belief of using one very large screen. So there are some fairly large screens out there you can get, or maybe even a television that would work with your computer. And I find that to be more effective for myself.
No, I'm the multiple screens, but I think I want to go to the one large screen because I've heard of some real benefits of one particularly large screen approach. So I need to follow your lead there. And it is interesting how your recommendation on having the duplicate set up at home or wherever your remote location is pretty critical. And that was definitely something, as you know, when we had to move to working at home kind of across the firm, we had systems in place to do that, on a one-off basis, depending upon natural disasters and things of that nature for emergency planning and the rest. It's definitely kind of a challenge to get all the duplicate setups going. So that's important. But I also think that kind of fits in with a favorite travel tip, because my favorite travel tip of late has just been having a separate setup for travel. Have that travel bag that has
Right. Got it.
toiletries and all the rest, so you don't have to keep repacking those, because when you keep repacking them, you inevitably forget something. So just having the travel bag that never gets sort of unpacked, with the exception of things that you have to wash. So yeah, duplication.
Thanks, Mike. Yeah, and I think you mentioned age, and I definitely feel with age, comfort is becoming a high priority in all the decisions I make.
It's a realization, much as an age. So thank you, Alvin. And to our listeners, I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.